The Federal Reserve had identified major issues with Silicon Valley Bank prior to its collapse. The bank had utilized an inaccurate risk evaluation model in the face of increasing interest rates and was subject to supervisory review for a significant portion of 2022. Before going further, we kindly ask you to leave us a like on this video and subscribe to the channel so you don't miss upcoming videos. Despite being aware of the bank's risky practices for over a year, the Federal Reserve was unable to prevent its eventual downfall. An individual familiar with the situation revealed that the Federal Reserve had issued multiple warnings to the bank about its issues. In 2021, a review by the Federal Reserve Bank of San Francisco, which was responsible for supervising Silicon Valley Bank, uncovered significant deficiencies in how the bank was managing critical risks. The Federal Reserve supervisors issued 6 citations, which were identified as matters requiring attention and matters requiring immediate attention, indicating that the bank was not effectively ensuring its ability to access sufficient liquid cash in the event of a crisis. Despite the warnings and citations from the Federal Reserve, the bank did not address its vulnerabilities. By July 2022, the bank was placed under a full supervisory review and was deemed inadequate in terms of its governance and controls. As a result, it was subjected to a series of restrictions that prohibited it from expanding through acquisitions. In the autumn of the previous year, representatives from the San Francisco Federal Reserve met with senior executives at Silicon Valley Bank to discuss the bank's ability to obtain adequate cash during a crisis and its potential exposure to losses due to rising interest rates. The Federal Reserve came to realize that Silicon Valley Bank was utilizing inadequate models to predict the impact of rising interest rates on its business. The bank's leadership was under the impression that increased interest revenue would significantly improve its financial standing as rates increased, which was not in line with reality. By the beginning of 2023, the bank was subject to a horizontal review by the Fed, which aimed to evaluate its risk management capabilities. The assessment identified additional shortcomings, but by this point, the bank's fate was sealed. In early March, the bank experienced a run and was unable to sustain itself, causing ripple effects throughout the broader American banking system. This ultimately prompted a widespread government intervention aimed at preventing panic from spreading. On Sunday, Credit Suisse, which was caught up in the panic that followed Silicon Valley Bank's demise, was taken over by UBS in a hastily arranged deal put together by the Swiss government. Serious concerns have been raised regarding why regulators were unable to identify and address issues early enough to prevent the collapse of Silicon Valley Bank on March 10th. In hindsight, many of the factors that contributed to the bank's downfall were apparent, including the fact that nearly 97% of its deposits were uninsured by the federal government, which made customers more likely to withdraw funds at the first sign of trouble. Furthermore, many of the bank's depositors were in the struggling technology sector, which was negatively impacted by rising interest rates. Silicon Valley Bank also held a significant amount of long-term debt that had lost value in the market as the Fed raised interest rates to combat inflation. Consequently, the bank suffered substantial losses. The Federal Reserve has launched an investigation, headed by Michael S. Barr, the Fed's vice chair for supervision, to determine what led to the bank's oversight failure. The inquiry's findings are expected to be publicly released by May 1. Additionally, lawmakers are conducting their own investigation into the matter, with the House Financial Services Committee scheduling a hearing on recent bank collapses for March 29th. From what has been uncovered so far, it appears that Silicon Valley Bank's leadership failed to adequately plan for the future and ignored significant financial and operational issues, despite repeated warnings from Fed supervisors. For instance, the bank's executives were notified of cybersecurity concerns, both by internal employees in the Fed, but failed to address these issues. The Federal Deposit Insurance Corporation, which has taken control of Silicon Valley Bank, has not issued a comment on its behalf. However, the fact that several issues were known to exist at the bank raises concerns about whether the Fed's bank examiners or the Board of Governors in Washington could have done more to push the bank to address its weaknesses. Despite some intervention, it was not enough to save the bank, and the reasons for this remain unclear. According to Peter Conti Brown, an expert in financial regulation and a Fed historian at the University of Pennsylvania, the situation represents a failure of supervision, although it is uncertain whether the supervisors themselves were at fault. Michael Barr's investigation into the collapse of Silicon Valley Bank will focus on several key questions. These include why the problems identified by the Fed continued despite the initial set of warnings in the matters requiring attention. It will also examine whether supervisors believed they had the power to escalate the issue and if they raised the problems to the Federal Reserve Board. The report by the Fed is expected to reveal information about Silicon Valley Bank that is typically kept confidential as part of the bank oversight process. It will also provide recommendations for regulatory and supervisory solutions. The collapse of Silicon Valley Bank and the ripple effects it caused are expected to lead to a push for tighter bank oversight. Michael S. Barr, who is leading the Fed's investigation into the bank's collapse, was already conducting a comprehensive review of Fed regulation, and the incident is likely to influence the findings. Additionally, the Silicon Valley Bank collapse may also lead to a revaluation of how the Fed supervises smaller banks. The Fed relies heavily on bank management to identify risks and take action to mitigate them, but the failure of Silicon Valley Bank's management to adequately address issues raises questions about this approach. As a result, the Fed may consider adopting a more proactive supervisory approach for smaller banks, including more frequent and rigorous stress tests and closer monitoring of risks. However, any changes to the supervisory framework would require careful consideration to ensure that they are effective and not overly burdensome for smaller banks. But as the Fed works to complete its review of what went wrong at Silicon Valley Bank and come up with next steps, it is facing intense political blowback for failing to arrest the problems. The potential conflict of interest between the Silicon Valley Bank CEO and his position on the Federal Reserve Bank of San Francisco's Board of Directors has raised concerns and prompted calls for changes. Senator Bernie Sanders announced his intention to introduce a bill to ban big bank CEOs from serving on Fed boards to prevent such conflicts of interest. While board members do not play a role in bank supervision, the optics of the situation are seen as problematic. The investigation into the Silicon Valley Bank collapse will also likely consider whether there were any conflicts of interest that may have affected the bank's oversight. The role of Jerome H. Powell, the Fed chair, and Randall K. Quarles, the Fed's former vice chair for supervision, during the Trump administration is also under scrutiny. Some observers are concerned that the Fed allowed too much deregulation during that time. It is worth noting that while Mr. Powell typically defers to the Fed's supervisory vice chair on regulatory matters, the Fed is a consensus-driven institution, and all decisions are made by the Board of Governors. Additionally, the Fed's regulatory rollback in 2018 was part of a broader effort by the Trump administration to ease financial regulations in the wake of the 2008 financial crisis. It is not uncommon for lawmakers to call for independent reviews of financial scandals or crises. The involvement of a top regulator in the regulatory rollback that some say contributed to the Silicon Valley Bank collapse has raised questions about his role in the matter. Senator Warren's call for an independent review underscores the desire for impartial analysis of the events that led to the bank's failure and potential regulatory missteps.